What are ETFs, why you need them, and how to invest the right way. This chart here shows you why you need to invest. On one side, VT, an ETF anyone can buy representing the global economy. On the other side, the purchasing power decline of major global currencies. Inflation slowly eats your money. On average, purchasing power declines about 3% per year. Meanwhile, the global stock market has historically returned around 8% annually over the long term. This is where ETFs come in, exchange traded funds. An ETF is a basket of companies you can buy with a single click. One of the simplest examples is the Vanguard Total World Stock ETF, VT. It holds thousands of companies worldwide. When the global economy grows, VT grows. This is long-term investing. You only invest money you don't need for at least 10 years. If you can handle more volatility and want higher growth potential, you can also add Invesco QQQ Trust. QQQ is an ETF that holds the largest tech companies. It's more aggressive, both up and down. Remember, markets move in cycles. You won't see massive gains overnight. Wealth building takes time. The most important part, psychology. Most people fail not only because they choose bad investments, they fail because they panic sell during crashes or chase hype during rallies. You need a plan. Decide what you're buying. VT only or VT plus QQQ. How often you invest. Lump sum or monthly dollar cost averaging, DCA, and commit for holding at least 10 years. Lump sum means you invest all capital at once. DCA means you invest gradually over time, ideal if you're earning income. So how do you invest? You open a brokerage account. In the US, platforms like Fidelity Investments are beginner friendly. Globally, I really recommend interactive brokers. Then you fund the account, you search for the ticker symbol, VT or QQQ, you place a market order, you own part of the world economy now. Keep in mind that waiting for a crash is statistically the wrong choice. On this chart, you can see that there's only a 15% probability that a crash will happen and the market will be lower in 5 years. There's roughly an 85% probability the market will be higher in 5 years from now. The longer your time horizon, the higher that probability becomes. Yes, markets can drop 30 to 40% in a bad year. That is normal, but you only lose if you sell early. If you hold, history shows long-term growth. Cash loses value, assets grow, time in the market beats timing the market. Hit subscribe to get more investing content. Check out the full ETF guide on our channel and download the cheat sheet explaining how the stock market works in the description of that video. Do you know?